Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest for this hour is Brian Perry. He is the editor of several high-yield-oriented newsletters, one called Cash Machine, another one called Premium Income. We're going to go into all of them. You can find out more about them at his website, brianperryinvesting.com. Welcome to the Money Answer Show, Brian.
Excellent to be with you, Jordan. Thanks for having me.
So for people who haven't heard about you, just kind of give a brief bio and how you've gotten to where you are today doing all these different high-yield newsletters.
Sure. Well, I've been in the industry for the better part of 35 years and started back in 1984 with Smith Barney and made my way out to California. Spent some time at Bear Stearns and Lehman Brothers, where back in the mid to late 80s, about the only thing in yield outside of traditional investment Jordan, was really high-yield bonds. And so I cut my teeth in the high-yield bond market when Drexel Burnham Lambert was and Michael Milliken were they were the hot firm at the time. And there wasn't a whole lot of choices outside of, again, money markets and municipal bonds. But even then, rates back in those days were considerably higher than where they are today. So I started getting enamored with the corporate debt world. And we were doing some very creative things with some of these companies that were going private, doing big LBOs, limited leverage buyouts and whatnot, like RJ Nabisco, for instance, Warner Brothers, some of the big European firms, and Chrysler, the big turnaround stories like that. So there was a lot of really interesting and creative opportunities where you could get some really fat returns from not just yield, but also from gains in these distressed bonds. So that's really where I started generating interest in this particular field, because I ran into more and more prospects that would really take an interest in wanting to find something that would pay way better than again, CDs and money markets and just dividend stocks from just blue chip companies. Having started, I was on radio with Bloomberg in the mid 90s and then early 2000s, and then was just found that a lot of people just kept calling in about, can you talk more about high yield? And so over the course of the several years, the numbers of assets that came to the market that offered high yield dividends and yields and in various different asset classes, it really took off and became more of a buffet table, if you will, of buckets where you could look at things other than just junk bonds, for instance. So I took it upon myself to write a book back in 2006 called the 25% Cash Machine, which was designed by a model to try to generate a double-digit interest level of interest on an asset class on a basket of assets, and then trying to grow the portfolio by 10 to 15% a year as well for a total return. That was the objective. Definitely, we were good in a few years, and other years going into 2008 and all that. That was a very difficult time. Yeah. But coming into lately, it's with interest rates having just crashed over the last 10 years to where they are today. There's just never been any more interest from the different venues that I talk to and the different channels that I work with and different medium distribution areas that where there's a very strong interest by primarily the retirement community is to how can I generate an income that I can live off of without blowing through my nest egg. Yeah. And that's really where I think that my experience, I don't want to just call it expertise, but because having gone through a lot of the different ups and downs with the different market cycles, I think I've got a pretty good idea of what works and what doesn't work in these types of markets. And that's been a challenge, but it's also very rewarding to be able to bring people these solutions to their income needs so that they can have their cake and eat it too without moving into a double wide somewhere in the middle of West Virginia.
Yes, indeed. Very good. Well, let's kind of take a look at the overall economic situation in the world to set up the kind of things you're going to recommend. Sure. So here we are. The market's been hitting all-time record highs lately. We have negative interest rates in Europe, $17 trillion worth of bonds at negative interest rates. Right. Our long-term rates are 2% or below, 1.5% thereabouts. You've had the Fed Reserve cutting rates 3 times recently. So how does this all add up? Is the economy growing? Is it getting weaker? Kind of how do you put all these factors together?
Well, this is a very timely time to talk about this because we're seeing a market pivot very hard in the last week and a half here into the cyclical sectors. It started out, where just a month ago we had this very soft ISM number come out on factory output, and
Yes.
and we've had actually 3 months in a row of declining factory output. And it just the market lost 4.5% in the first week of October. If you remember how it got kneecapped,
Yes.
and it looked as if the slow growth in Europe and the trade war with China was starting to wash up on our shores. And although industrial production in America only accounts for 11% of GDP, it was people were wondering, is this the canary in the coal mine that's finally going to hit? And so therefore it was a sell first, ask questions later kind of a market that week, and then the notion of a phase one trade deal started making the rounds, and then the idea that the Fed was definitely going to, you saw the Fed watch tool probability just explode higher to like a 98% chance that the Fed was going to drop rates at the recent FOMC meeting. And then you also had the chatter going around that there was going to be some kind of a Brexit deal that wasn't going to be not with a hard landing.
Yeah.
And so those things together started getting some push and some positive play. And this market is like Rocky. It just you can hit it, but it just keeps coming off the mat. And a lot of that is because of stock buybacks, dividend increases, a lot of M&A. The market's just getting smaller. I mean,
you had buybacks. I mean, there's just less equity outstanding. Yeah.
Well, we had over 9,000 stocks to trade 20 years ago, and today there's about 3,600.
Yeah.
So the stock market is disappearing, and the world's awash in cash from all this QE liquidity everywhere. Yes. And where they have the strongest balance sheets in the world, money continues to come here. The dollar's been strong. Thankfully, it's actually given back some ground lately. The Fed's gone to neutral, and we're at a kind of a sweet spot here where the market is anticipating that the third quarter that we just went through may be a trough, and that may be a soft spot, and then we're going to start to see a reacceleration of growth here in the fourth quarter going into 2020. And you're starting to see a lot of money flowing into the emerging market and European ETFs and whatnot the last week and a half. So it's interesting because the data doesn't support it yet, but the market tries to take it.
Market's always ahead, right? The market's ahead of when you actually get the data. Right?
6 to 9 months out, hopefully. And
yeah. One of the key factors is the whole Chinese situation. So they had this negotiation. They came and they had this love fest in the Oval Office.
Right.
Phase one is about to happen. I think you're a bit skeptical of that. What is your estimate of what's actually going to happen when they put this down on paper? Are the Chinese going to have made the kind of concessions that it seemed they made when they came out of those negotiations?
I'm very skeptical of them actually, signing over some kind of a verification process by which they're going to change the rules to identify IP theft and forced technology transfer. I have a really tough time with that. Today, actually, we saw an olive branch from the administration talking about lowering some of the restrictions on Huawei sales by U.S. chip companies. And so you're seeing a big pop in a lot of the semiconductor stocks today. There's a lot that happens, walking down the aisle with the Chinese before you get married to a deal. And I'm just not, they're talking up like they're very constructive things are going to happen. It has to go way beyond the business of buying soybeans and just doing agricultural, trade and retail. I just don't know how they're going to bring themselves to allow the U.S. to get behind the curtain and verify a lot of the cyber espionage and things like that, Jordan. I just don't. Yeah. I'm really skeptical.
If your skepticism is right, and in fact we don't get a deal, or it falls apart again, and we impose more tariffs December 15th, would that have a major negative impact on the markets?
Here's the thing. Every time this has come around, the market seems to shake it off better than the prior time. Every time we get, the market cries wolf or the trade war cries wolf. What you're seeing is even with the trade tariffs in place, we haven't seen the material breakdown in economic GDP numbers and data that everybody was forecasting. Not everybody, but the critics, the market critics. And so therefore, the U.S. economy has done a pretty good job of shaking off the effects of a trade war. And China actually hasn't melted down, unless their numbers are just not straight up. They just a lot of people thought that their GDP would just be really in the tank, given what all that's already happened. I think that it will be a negative, a net negative, because the market has moved up in anticipation of this phase one deal, sailing through in its current form, and that there's going to be some kind of a kumbaya moment here for the very critical, what Peter Navarro would call some of the seven sins. That some of that's going to get resolved. Yeah. We all hope it does, but you're talking about and I think a lot of it's still they're waiting to see if Trump is in trouble with this impeachment situation here, and whether or not he's really going to be, head and shoulders above the rest of the competition for his second term. I think they're experts at the waiting game, and I think this could still get pushed out yet again with just more. Hey, we just want to have longer, more understanding, longer talks about it. So I'm not sold on it. The market is buying into it, and the market usually tends to be more right than wrong, and so we're going to get some kind of a deal. It may not be everything that we're looking for. Even phase one might be, phase 0.9 instead of phase one.
Yes, very good. Okay, we're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Brian Perry. He is the editor of several newsletters aimed at high yield. One of them is called Cash Machine. Another one's called Premium Income, Quick Income Trader, and Instant Income Trader. You can find out more about all of them at his website, brianperryinvesting.com. We'll be back after this.
You've been listening to The Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to The Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Brian Perry. He is the editor of several newsletters aimed at high yields, and he's been doing this for a long time. Welcome back to the show, Brian.
Thank you, Jordan, very much.
Let's just briefly go over the different newsletters that you do and how they're differentiating. One of them is called Cash Machine, Double-Digit Income Investing. Tell us a little bit about that one and what people would find in there.
Well, here what we're doing is we're going after a portfolio of somewhere between 20 and 30 different securities. It could be any number of sectors and certain asset classes. I incorporate things like closed-end funds, master limited partnerships, business development corporations. We'll use straight-up securities like mortgage REITs, things like various different, not exotic but unique securities like exchange-traded notes, for instance. And I'm trying to also blend quarterly payment securities with monthly payment securities. And in doing so, we're able to manufacture a blended yield of around 8.5, 8.6% in the current marketplace, which is, north. That's almost 4 times what the short-term monies are paying out there in the world, and 4 times easily what the S&P is paying. And comparatively speaking, it's just really hard to beat that kind of a yield that's diversified and still has a lot of what I would call non-correlating assets, so that one of the portfolio is zigging, another part of it is zagging. So there's a lot of even a smooth ride, as I like to call it. Well,
another of your newsletters is called Premium Income. What is the strategy involved with that one?
Well, that's based on using the Cash Machine portfolio and then selling covered calls on high yield securities. And so it's a hard and tricky thing to do, because high yield assets tend to move up and down toward their dividend dates, because they tend to, they'll rally in dividend dates and then pull back once they paid. But I try to add another 8 to 10% income over the course of a year in covered call income to the existing portfolio, so that we can realize somewhere between 12 and 15% total income without having to use margin or other types of leverage. And it's just a nice way that people can bring in extra income using the covered call, writing covered calls on high yield stocks and assets.
And then you have a newsletter called Quick Income Trader. How does that one work?
Well, this is more of a swing trading service where I'm using the positions that are mostly blue chip stocks and ETFs. And what I'm doing there is I'm using a concentrated portfolio of no more than 7 different securities. And then I'm looking for to sell covered calls. I'll buy the stock. I'll set a covered call that's out of the money and also at a higher price using limit orders. So therefore, the stock has to move 2 or 3% higher, and it'll trigger the out of the money covered call. And we're looking to generate between 5 and 7% returns over the course of each 30 to 45 days in those particular trades. I also use an associated naked put strategy to go along with that. So if we're going into Intel, for instance, at a certain price, I'm buying the stock, I'm selling a covered call at a limit price that's out of the money, and I'm also selling a naked put at the same price as I'm buying the stock. So that we're generating income 3 different ways, because Intel still pays a dividend.
But it's not a fast trade. I mean, you might do 1 or 2 trades a month. It's not kind of day trading.
No, not at all. We were looking for between 4 and 6 week holding periods during this. It's a targeted trade, directional trade, if you will, Jordan.
Yeah. And then you've got a newsletter called Instant Income Trader. How does that one work?
This is a little more sophisticated. This is where the problem with a lot of the stock markets today for investors is most of the best stocks trade well north of $100 a share. Okay, so if you want to play, Google or Intuit or, Alibaba, for instance, or Adobe, you got to really pony up a lot of capital to buy 100 shares of stock. So what I'll do here is I'll recommend what are called long-term equity anticipation securities, or LEAPs. Now, these are basically just long-term call options. And you can buy those, and I'll buy them deep in the money. And if for instance, I like kind of like Boeing down here because it's been hit hard on the 737 MAX. Stock trades at 350. I'll buy the long-term 1 or 2 year call option on Boeing, and I'll buy like the 320 call, 30 points in the money. I'll pay some time premium for that, but I've got a couple years worth of time, and I can buy that security for like $3,000 instead of $35,000 to control the same 100 shares of stock. And then I'll I'll try to sell a short-term out-of-the-money call against that long-term leap, like something that expires in December, if you will. And so ideally, the objective there is to generate between 20 to 40% returns. These are what are called bull call spreads. And it's exciting because that's really where the action is. If you want to buy, you can buy Apple for a fraction of the cost of the stock and buy yourself a couple years of time. And now you can play Apple and get fantastic returns by using bull call spreads.
Uh-huh. And the final newsletter you have is called High Tech Trader. That doesn't sound like it's high yield at all. What is the idea of High Tech Trader?
Well, this is a AI-driven, algorithm-based trading service that I use. I've got 2 proprietary algorithms that I've had designed to construct trades that only go into technology stocks. And there's a number of indicators that go into that. And we just maintain a 5 to 6 position portfolio in one side of it. And then I just launched what is called just a 5G portfolio because I'm a big believer in the next 2 to 3 years of having a strong focus just in 5G. And what we're doing there is we're using a 22-day, between 1 and 22-day holding period is our objective there. It's a straight-up short-term trading service looking for, between anywhere between 1 and 10% returns on a short-term basis or inside a month. And then we're also recommending a corresponding call option to go with that trade. I usually buy, if I think the trade's going to happen in a month, I think I'll buy 3 months worth of time. That's kind of a rule of thumb in option trading. If you just buy 3 months, there are 3 times the amount of time you think it's going to take the trade to work. And so that's just a highly concentrated portfolio that I keep really no more than 10 positions on at any given time.
So let's talk about 5G. People hear a lot about it. It's just starting to be rolled out in various areas. What is going to be the impact of it, and what are some of the ways to invest in it? Because there's a lot of hype about 5G these days.
There really is. I mean, you've got just the whole business of Internet of Things, the wireless, network, the smart home, the autonomous vehicle, robotics in the factory, medical, remote surgery. All those things require 5G. It's 100 times faster than the current 4G technology out there, and it provides incredible amount of the ability for these other technologies to move forward, which really they can't without 5G, and fulfill the very prospect of what they're trying to do in terms of bringing things like artificial intelligence to its to its full capabilities. I think it's you're going to have it's about a 3-year build out. What's going on here, and you've got some big potential winners there, primarily in the cell tower space, on some of the chip makers, some of what we call software on the chip makers that make this possible. Certainly the network installation people that put the gear in. So there's different ways to play this, and it's a matter of it's a little bit like the Bitcoin revolution, where if someone had a blockchain strategy, it could be a food company and say, we got a blockchain strategy, and they'd buy the stock,
Right.
So you got to be careful here, that what people claim to have is actually, a 5G technology that is
real. Yes.
It's real, and hopefully as much of a pure play as possible.
Why don't you just give us one idea? I know you have several, but just one idea of a way to play 5G that you would recommend.
Sure. Well, in this particular environment right now, we've had a big rotation out of REITs and utilities and staples because of this market move into the cyclicals. I think it's a great time to look at both the cell tower companies right now that I recommend. One is American Tower, AMT. They just had really good numbers here last week. They're going to be, they're the leader around the world in global in tower installation. Stock traded as high as 242. It's trading around $212 today. So it's at a nice deep discount to where it was trading recently. And, and they're going to be able to basically charge considerably more money for the use of these towers than they currently have been able to do, as everybody has to ramp up the usage of, and just a much higher usage rate at these towers using 5G than currently are being used with 3G and 4G. The other one is Crown Castle International. They're basically the biggest tower operator in the United States. They have 3,400 towers, but they're going to be installing 5G. The range for 5G is less than 1 mile. Okay, so if it's conventional towers, you can use your cell phone and your iPhone, for instance, and your towers can be 6 miles apart. Okay, you don't lose connectivity.
Yeah.
5G connectivity requires 1 mile. It's got a 1 mile radius between antenna to antenna. And the antennas are much smaller. They can put them on buildings, on lampposts, and things like that. And they can basically grid out the country using existing infrastructure. So the install of this is huge. And Crown Castle is the biggest in that particular field, and they also operate some underground fiber optic networks. But as a 5G play, the stock was trading at 150. It's back down to 135. A lot of insider buying in the stock right now, and I think people should take a look at both these tower stocks because you're getting paid some nice dividends, and it's basically a 5G utility, if you will, and gives you a chance.
What kind of yields are they both paying?
Well, CCI pays about 3.55%. Okay, which is pretty good for that kind of for a hot growth REIT, and the other's paying 2% for American Tower.
Very good.
So not great, but still, most 5G plays are pure growth, and so people do. And these are much more lower, what I call lower beta. They just don't move around as much as like a Xilinx or some of the chip stocks, which can fly all over the place.
Indeed, very good. All right, we're going to come back. This is Jordan Goodman of the Money Answer Show. My guest this hour is Brian Perry. He's the editor of several high-yield newsletters we talked about, Cash Machine, Premium Income, Quick Income Trader, Instant Income Trader, and what we just talked about, High Tech Trader, particularly relating to 5G stocks. You can find out more about all of them at his website, brianperryinvesting.com. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Brian Perry. He is the editor of several dividend-oriented newsletters, one called Brian Perry's Cash Machine, You can find out more about all of his newsletters at brianperryinvesting.com. Welcome back to the show, Brian.
Thank you very much.
So you talk about the buffet table of creative income opportunities. Let's go eating from the different parts of the buffet table.
Okay.
So one of them you mentioned is called BDCs, business development companies.
Right.
So basically describe what that is and maybe give us one or two examples of one you would like, and what's the advantage of putting money into a BDC if you're an income investor?
Well, BDCs are very similar to REITs. They are regulated investment corporations, and they've got to pay out roughly 90% of their income in the form of dividends. The difference is they can use leverage, and they can also use derivatives in which to manufacture their yields. So the business development company is an entity that loans money to small to medium-sized businesses, usually in the form of loans that are somewhere between $3 million and $50 million. And there's a number of them out there that choose various different markets to invest in. You got to be very choosy about it because management styles are quite different, risk levels are quite different. You really got to know what's in the portfolios, and you've got to know whether or not the income they're bringing in is going to cover the dividend payout. Presently, I've got just 3 of them on the books right now. I used to be a bigger, you have to have more exposure, but I maintain 3 portfolios in the cash machine service. One's called aggressive high yield. The second one's called conservative high yield. And the third one's called safe haven portfolio, which I have no BDCs in the safe haven portfolio. So they are in the middle risk range for income, Jordan. They generate anywhere between 7 to 12%, depending on the flavor of the BDC. And at the top, my best performing one is involved in venture capital and angel investing in Silicon Valley companies and life sciences. So that's been a really big performer. I'm throwing the name out, Triple Point Venture Growth, and it's returned 67% to us in the last 2 years. So to give you an idea, and it still pays even at this level of appreciation, still pays a current yield of 8.8%. Wow. So we're getting 8.8%. We're getting fantastic growth, and then they had, they're early investors in Uber, Lyft, Pinterest, all these names. They were early into Facebook. So it's a way that that the investor can get into the incubator type of early investing, early cycle investing in some of these really hot names. Because no one's going to get that kind of stock on the IPO. Typically It's usually reserved for just the big boys. So you can buy into something like a BDC, which is lending money and lives and breathes Silicon Valley, and then that's a nice way to play it because you get a piece of the action.
If the economy were to turn down, would you be concerned that they would have these BDCs in general would have more defaults, or some of these loans would go bad?
There is that risk, yes. It depends on what they're in, for instance, and what you see also is a tremendous slowdown in what we call deal flow. You just don't see near as many deals come to market, and a lot of companies don't qualify. They just for the lending practices of whatever the parameters are that these BDCs have outlined. You do see, and here's the thing about high yield, Jordan. It definitely is more correlated to the stock market than the bond market. These are stocks with yield, and so even if interest rates go up a little bit, but the market continues to grind higher because of the economy is expanding. They tend to do quite well. It is, again, if we go into a slowdown of periods, then you really want to cut your exposure to companies that are loaning money to companies that are more susceptible. They're small cap companies, and so therefore your risk is definitely more inherent.
So another entity, I guess you might say, on your buffet table are MLPs, Master Limited Partnerships. So those tend to be in the energy infrastructure area, pipelines, storage facilities, ports, things like that. Oil's been kind of weak lately, and it seems like there's too much oil. What is your outlook for MLPs, and what would be a name or two you'd like in that field?
Well, I've only got really 2 energy MLPs right now. One of them I'm very bullish on, and that's Senior Energy Partners. That's in liquefied natural gas, which has taken over coal as the number 1 fossil fuel that's being exported around the world. Japan, after their nuclear disaster there 2-3 years ago, has gone pell-mell into LNG imports. Coal is being replaced rapidly in China by LNG. Europe is moving rapidly into LNG from nuke. And so this is a monopoly type of, or oligarchy type of a business. There's only 2 or 3 companies out there that produce LNG in the United States that export it to around the world. And the largest one is Senior Energy, CQP is the symbol there. And it gives us a chance here to be in the largest, and it pays a 5.5% yield, but we're up 55% in that position there in the last 3 years. And it's just, again, that's the kind of MLP I want to be in, where there's special situations. Another one is simply, you can look at, I like to follow the money, as we all do on Wall Street, and Carl Icahn is, a billionaire many times over, and Icahn Enterprises is in my aggressive high yield, because when you invest with Carl, you're getting in with an activist, and but he owns 92% of his own company called Icahn Enterprises, and that he pays himself very well. I mean, the yield on those shares is 11.5%.
Wow.
And he's been hiking the dividend for the last 3 years. And so we're up 20% in that year over year since we bought it in mid 2018. And Icahn is he's brilliant. He just moved his operations to Florida, to get out of the way of the rising taxes in New York. He's got a lot of big holdings in there, refining. He's in things like, he owns Pep Boys, the automobile parts company. He's got all kinds of various different assets in the entertainment industry. He's a real wheeler dealer in the casino business. Yeah. And it's just, that's another that's an LP though, an MLP. So you don't always have to be in energy in order to be in LPs. Yeah. So I like gas stations. We own a gas station MLP, which pays 10.5%, and we're making money in that. So a lot of the infrastructure pipeline companies, what we call midstream and downstream companies, have not done that well, and they're still lagging in the market, terribly, quite frankly. But there's plenty to do. We just sold Blackstone Group, BX. They just converted from an MLP to a C corporation recently. Stephen Schwartz is easily the smartest guy in the room wherever he's at, and who runs that company, and that's private equity. And they just got ahead of itself. I think that from the standpoint of the stock, raced up higher recently, and we booked a 65% gain on Blackstone Group. And I'm looking at the Carlyle Group. Carlyle Group is converting from a MLP to a C Corp soon. And it gives institutions a chance to buy because institutions are loath to buy into MLPs because they don't want a K1 report, which is that can be a tax burden for a lot of different entities out there. So when MLPs convert to C Corps, and we're seeing more and more of that in the energy space as well. One Oak and a couple of names like that have done that already. Yeah. Kinder Morgan. And so we're seeing a conversion, if you will, of MLP. So that's a good space if you can be selective and look at alternative types of MLPs other than just what we call energy infrastructure.
Another category would be closed-end funds. These are funds that come out with a certain number of shares and they trade at a premium or discount to the net asset value. What are some high-yielding closed-end funds you'd be looking at?
Well, the couple there that really catch my eye. One is to be in a convertible bond fund. The one I like is Alliance Global, Diversified Income and Convertible, ACV, Alpha Charlie Victory is a symbol there. It pays around an 8.9% yield right now. And what this is nice is because even if the Fed's done lowering interest rates, a convertible security allows you to buy a bond that's tied to the underlying common stock. So if the stock moves higher, you have the right to convert the bond into shares. And so it can be a convertible bond, it can be a convertible preferred, but it allows you to be in a high income instrument. And if the underlying security moves up in value at your election at any time, you can convert that bond or that preferred stock into the common stock if you think that you're going to get a better ride out of your money doing that. So that gives you a good opportunity to kind of have your cake and eat it too if you want to still be in a bond play, but you're concerned that the Fed's done lowering interest rates and you might be in an uprate market here going forward, but you're still going to be in a strong stock market. This way you can still get paid 8 to 9, 10% and be tied to the stock market and the rising stock market. So that's just a beautiful thing. And the one we bought about a year and a couple of months ago, we're up 19.5% in that, that's a nice conservative way to get your 8.5% and still make some money in the stock market.
Do you like to buy closed-end funds when they're trading at discounts or premiums, or do you look at that when you're looking at closed-end funds?
Absolutely. I don't like paying premiums. It's got to be an awfully good reason to buy it at a premium. One I did pay recently for a very small premium for was one that involved in all the large cap NASDAQ QQQs. What they do is they're buying all the best stocks like Microsoft, Google, and all the big names out there. And they're selling covered calls against that portfolio. I want to be in big tech. I want to be in IT because that's the strongest sector in the market typically. And we've seen a breakout recently in the chip stocks and in some of the big cap software stocks. And I want to be there in that sector. But how do you get paid? How do you get paid to, if you're an income investor and still be in these stocks that paid almost nothing, in terms of dividends? The way to do that is to be in a well-managed covered call fund that has a reputation of putting together, pretty fat returns over the course of years. And I've got one that within Cash Machine that pays a current yield of 8.6%, and it owns all the best names at the top of the Lam Researches of the world and things that have really been working well in the chip space and the software space and some of the other high-tech areas where there's good leadership.
And then REITs is another category, real estate investment trusts. Mm-hmm. They've had a pretty big move this year, but do you see value in some REITs these days?
Yeah, there's a few places to still go, which I think make a lot of sense. One is certainly the data center REITs. Those are still, they have a good long trajectory of growth forecast still for the next several years. We talked about the cell tower REITs already. Certainly some of the standalone, what I would call standalone, not retail mall REITs, but ones where you've got
strip malls. Is that
yeah. You can go to a local, grocery stores tag, but you still have to go get your tires changed. You still got a urgent care there. You've got your hair salons and things like that. Things that you can't. They're kind of Amazon proof. Okay, they're services, and you just but they're not something you can't order a haircut over the internet. So those are good. There's two or three there, and then certainly in the healthcare space, there's any of the standalone, what I would call ambulatory type of outpatient clinic stuff is doing quite well. We've got one or two of those in the portfolio. They're doing extremely well right now, and the more healthcare there is for all, this is the way you can. If you're play if we're going in that direction, then we're going to get more and more of that type of government-backed type of medical care, then certainly the operators of the standalones are going to do quite well in all of this because they're just going to be, the patient visits are going to be that much more rapid.
Very good. We're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Brian Perry. He is the editor of several high-yield oriented newsletters, one called Cash Machine, Premium Income, Quick Income Trader, Instant Income Trader, and High Tech Trader. You can find out more at his website, brianperryinvesting.com. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Brian Perry, the editor of several high dividend yielding oriented newsletters. You can find out more at his website, brianperryinvesting.com. Welcome back to the show, Brian.
Thank you, Jordan.
Another area that you look at is preferred stocks. Maybe just talk briefly about what a preferred is and how they're trading and some ways you'd like to play those today.
Sure. Well, a preferred stock is a debt security, unlike a common stock, which is equity. It stands in the pecking order of you have your senior debt at a corporation, the bondholders get paid first, then your junior debt holders, junior bondholders, and then your convertible bondholders would get paid third, and then your preferred shareholders get paid fourth. And this is basically how the priority will of who gets paid first when the company makes money, and in an event of a liquidation. The bond, it also works the same way. The common stock dividend holders are paid last and suffer the highest risk of having their dividend cut in the event of a company going bankrupt. So the preferreds and therefore you get paid more to be a preferred holder than you do a senior bond holder because you're third or fourth in line. So in this realm, I've got, with, again, the 3 portfolios that I use, and I've got a preferred instrument for each of the portfolios because it's been a very good market for preferreds. It's because it's right in the middle of, it pays better than the common stock, not as, and still, gives you, you still get the security of being in a what I call a debt security or like a bondholder. They don't move around as much as a common stock by any means. They're very stable. So, at the top, I've got one that pays over 10%, about 10.3, and that's in the form of what is called an exchange-traded note, and that's issued by UBS, United Bank of Switzerland, and they take the bank basically backs this preferred note, which is based upon a preferred index, and they use derivatives in trying to manufacture 2 times what the preferred, what is called the standard preferred index pays. So in this event, most preferreds pay about 5.5% in the current market, and which is a great yield. But if you're using an exchange traded note, which is leveraged 2 times to the preferred stock index, we're getting 2.5% without using margin. They do all this internally, and you get paid a monthly payment. So that's been extremely good for people to say, I want I want a really fat yield in the preferred market. Now, but you can get that through an exchange traded note.
So you'd rather do it through the ETFs than buying individual preferreds, is that right?
I would, yes. I would, personally, because I like to have a good manager in there that knows how to swap these in and out. I don't mind. One of the names we'd use as in that area would be the Virtus InfraCap US Preferred ETF. The symbol's PFFA, Peter, Frank, Apple. And it pays 8.66%. They're using a little bit of leverage here, internally. So it's an exchange-traded fund, which is using around 30%, between 27 and 30% leverage, because they can borrow money at 2, and then they can invest it in 5.5–6% preferreds, and therefore they're kicking out almost a 9% yield. It pays monthly. We bought this in December of last year, Jordan, and we're currently up 24% in the position. So, here's the stock market, which has put you through a lot of different gyrations here during the course of the year. And then you've got this preferred ETF, which is just a nice steady up into the right pattern, paying still at this level 8.66% and getting paid monthly. That's just a beautiful thing for people that want a stable income during their retirement years. Uh-huh. And then thirdly, I like one that's very conservative and is put out by the same manager, but it's investing in preferred stocks that are owned by REITs, by real estate investment trusts. And this is in the exchange-traded fund that invests in REIT preferreds. And it's paying 5.6% and pays monthly. And I did this one primarily because I still have the a general audience that wants a monthly check. And so therefore, just a nice way to be in a very solid, and I trust the U.S. domestic real estate market is going to be, it's on good footing right now. We have strong job numbers, strong credit. People's savings rate is up. It's just a good market for real estate. And so therefore, we can own preferreds in 3 different categories and 3 different levels of risk. And that way, it just gives people, the different various risk-reward levels of a choice.
Great. So let's go back to options a little bit. What is your strategy in selling covered call options? There's so many options out there. How do you pick which stock you want to buy and you're in the money, out of the money, which option to sell?
The secret sauce that I use is to buy a stock, and then again, that's basically, I look for stocks that have broken out to a new high, and then they've just pulled back, and I call it the pause that refreshes, called the back and fill to the breakout point. And so I identify those stocks, and then I basically come in there and I recommend to buy the stock, and then selling covered calls is a matter of, if you sell right at the money, then you have and you sell something that's only 30 days out, then you have the risk of having that position called away immediately, and then you got to rebuy the position and do that over and over again. Ideally, if you can walk a stock up over the course of several months, if not a year, and stay in the same position, and you basically, when the stock rallies, you sell covered calls against that position, and then when the stock pulls back, you either close out the covered call at a discount, or you just let it expire worthless, and you take home 100% of the premium. So that's how I try to trade the covered call market. And and again, I'm looking for calls that I can sell 30 to 45 days out at a higher price than where the stock is currently trading. And if the stock does get called out, then that's usually not a bad thing. It usually means the stock has moved up between 3 to 5%, and I'm getting paid another 5 to 6% on the call, and I'm making 10% over the course of 30, 45 days. Well, if you do the math over the course of a year, those are strong returns.
Yes.
And that's the beauty of a really well-managed covered call program that someone with my experience lives and breathes this stuff every day. And it just, most of the people I know that rather just have a cup of coffee and follow the trade directions and just put these trades on if they've got all the parameters that are already spelled out for them.
Yeah. And then the opposite of that is to sell a naked put. A put is giving you the right to, if you're selling it, you have to buy the stock back at a lower price than it is today. What's the advantage of selling naked puts?
Naked puts are a phenomenal way, and in fact, for most professional option traders sell naked puts in terms of the most successful option traders. And what you're simply doing there is, say Microsoft it just broke out recently on beautiful numbers, and also they won a big contract, the JEDI contract from the Pentagon. The stock has been in a 3-month base, and at 140 broke out. Now it's trading at 144. If that stock pulls back to 140, 142, then I'd be selling the 140 put, say for January, for instance, and I might get $4 or $5, which is $400 or $500 per contract for that. Okay, I'm very confident that Microsoft will hold that 140 level. And what I'm doing there is I'm selling. When you're selling puts, like selling calls, you're basically selling the time is working for you instead of against you, and because these are time wasting assets, and so therefore, if I can sell that. Someone thinks the stock's going to fall back to 135. That's why they're selling you the put at $5. I'll take that $5. And here's the thing: if the stock, say we run into a black swan event and the market just nosedives, by 10%, and Microsoft does go to 135, and I get assigned the stock at 140, and I sold the puts at $5. My actual cost basis is 135 because I take my, I've been assigned the stock at 140. I brought in $5. I'm at 135. And if I get assigned Microsoft, I don't mind owning Microsoft because it's not, some funky name that no one's ever heard of. This is the most coveted name in Swiss bank accounts today. It used to be IBM, and Microsoft is the most coveted name in the world by the wealthiest people in the world today. So I don't mind being put Microsoft if that's I get it caught, in a black swan event, and I've got to own some stock, and I get put some stock. So that's. And those have worked out real well for us because the market is generally grinding higher. And if you can use sell-offs to sell puts against on very high quality stocks, then you'll usually make some pretty good money. We've been averaging between 30 and 40% on these trades each and every time we do this, and we're making money 85% of the time on these trades.
Great. In about 2 minutes we have left, just kind of sum up what difference it'll make in people's lives if they take some of the advice you have in your newsletters, instead of being scared and just keep their money in a money market fund because they're just too worried about all the things going on in the world.
Well, people love to talk about year-to-date numbers, Jordan, and yeah, the market's up 20% year-to-date, roughly speaking. But if you go back go back to February to September of 2018, we're not up 22%. We're up maybe 4 or 5% from those levels a year ago and change. So there's a misnomer here about using year-to-date numbers versus going back and saying, hey man, back in February of 2018, the S&P was trading at 2880, and today it's trading at 3050. That's not a big move, But you went through all the fourth quarter of last year, and then again this year in May, and again in August, and now we're back up. But it doesn't tell the whole story. And if you can still make a steady 8% and maybe 10% or 15% in these income strategies along the way. If you're just buying and holding and having to sell a portion of your assets in order to meet your obligations in order to live on, then you've got to depend on rallies and market rallies all the time in which to make that happen so that you don't beat into into the rock. Yeah. And so by using income strategies, you can constantly get paid every month, every quarter, year in and year out, and still move through the market swings, but your portfolio is paying you organic income all the time, and that's really why I think that this is a very good positioning for most people.
Very good. All right, well, thanks so much. My guest this hour has been Brian Perry. You can find out more at his website, brianperryinvesting.com. Thanks so much for being on the Money Answer Show, Brian.
Thank you very much, Jordan.
And we'll be back next week with another edition of the Money Answer Show. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time right here on Voice America Business. See you next week.